All right, guys, good afternoon. Welcome aboard to the market recap. I'm having a little issue with OBS. I was trying to do the webcam thing. I think I turned it off, and I was running a little late. It's already 4:18. I said that we were going to do this at 4:15. So welcome aboard. I appreciate you guys as always. So again, we'll go over the week. Pretty bloody one. But let's go over quickly. Dow Jones closed down 345 points. It's a little off the lows. Nasdaq was down as much as 2%. We down 1.76%. S&P down 1.45% at 3861 on SPX. The VIX was a lot higher today. I think it was up as much as 25%. We closed below 25 at 2480, up 9.69%. Equal weight S&P down 2.11% since tech fared better than the banks that were dragging down the S&P. Speaking of banks, the IWM, which is bank heavy, which is small caps, was down 2.88% today. The dollar was down today, again, 0.67%. And at that point, it really doesn't matter the correlation at this point, because dollar being down did not help the S&P 500, obviously. But bonds did fall. Bond yields, 3.695% below a 3.7% yield on the 10-year. Down 5.86% on TNX. Investment grade credit caught a bid, 1.43%. Here, look at this, HYG. This is high yield credit. Flat. Should have been a lot higher. It was a lot higher earlier today. TLT, which is the 20-year Treasury bond fund, 105.59. You could see that caught some bids today. So again, a lot of bond buying in terms of looking for some safety when you had the bank run with Silicon Valley Bank. That's what happened today. That's where really all the fears came from, was that bank. Again, they was taken over by the FDIC, the consumer deposit side. But the loan side, and kind of getting the breakdown of what I was reading, what I read about Silicon Valley Bank, what happened with them, is that during the time of the pandemic, 2020-21, we had very easy money policies, low interest rates. So they had excess deposits, obviously, from people in Silicon Valley, growth companies. We know the drill. You know, it's easier to make money with cheaper money, is the saying, right? So again, near 0% interest rates. Again, big loan book. Venture capitalists in Silicon Valley use it, or used to use it. And then what happened was that they took those deposits and invested in treasury bonds. The problem is that those treasury bond values fell because yields went higher. Remember, we talked about the inverse correlation between bonds and yields. So they were holding, I think the yield on those MBS, mortgage-backed securities, was right around 1.86%. So those bonds don't look very attractive when you can get a 2-year treasury yield, well, it used to be, right around 4.8%. So again, this is the downfall of bond buying sometimes, that you may get a consistent yield, but the face value of your bond may fall, adjusted for yield. So that's kind of where they got in trouble, from what I was reading. Obviously, still developing as we get more information. I think I'm happy to say I don't have any money with that bank or anything like that. I've never even heard of that bank, but they're an S&P 500 bank. So this is what happens with confidence in terms of banking. Very similar to 2008. If one bank goes down, so other banks get worried, and this is what you got for it. So here we go. This is the heat map of the S&P 500 today. JPM, we did play JPM calls today. Well done, team. They caught that early this morning. Got a big volume boost. We'll talk about that here in a little bit. Wells Fargo ended the day green. I'm keeping an eye on Citibank, seeing if we can break 49. Maybe we can retrace some of these sharp moves down from the banks. But you could see a whole lot of red. Intel, one speck of green. Healthcare did okay, pretty mixed. Let's go and take a look at the groups. You could see pretty much red. Consumer defensives, usually when the markets go down, they're going to be doing the best. Healthcare, relatively strong. And you can see real estate absolutely obliterated. So you can imagine real estate, obviously, with banks is very, very crucial. Liquidity issues arise, can't really borrow. So then what happens? Construction for homes stop. But I don't think we're at that point yet. But again, real estate taking a hit. Even with rates going down, financials, real estate, all got hit. And that's what we had this week and today. Materials being the worst performer, 8% down, real estate right behind it, and financials down about 7.33%. So a pretty ugly week. So let's go to the year to date and kind of give an idea, a little perspective. Technology is still up 9.37%, a little off its highs, obviously. Cyclicals up 6.46%. Utilities, healthcare, consumer defensives, energy, real estate, financials, all red for a year to date. So let's say if you bought financials this year, an XLF, a fund, you're pretty much down 1.59%. So pretty ugly price action, obviously. I don't think anyone is happy to see that. But that's where we are, at least currently. Let's go ahead and take a look at the S&P 500. I want to go over a couple of ranges, a couple of lines here on the screen, as always fun. And we can here at 38.65, even with the bank run, FTX, tightening Fed, lower money supply, higher labor costs. We're basically at the same point we were pretty much in. Let's see where we can compare this to. What, May 20th? Again, we're still in that chop zone range. Again, we rejected this level. I thought we would get to 4,100, which was a level that I wanted to sell from anyways, but we got pretty close at 40.81, and then we rejected down. Problem is that now we're below the trend line. Now we're below the 200-day. So obviously, nothing good happens below the 200-day. So I have no problem shorting anything here. The problem I'm looking for is that it's expensive. So now put-call ratios are very elevated. Puts are going to be very, very expensive. So what we want to do, at least on my side, what I'm looking for is counter trends or reflex rallies or fades. So what I'm looking for is if we can get back to around 3,900 to the top end of this, we can go ahead and play puts again and get them a little cheaper. Again, I just want to get something a little cheaper in terms of puts. I don't want to buy at this very moment here near a possible bottom, which is right around 38.36. Really, the level you're looking to hold for in March is 3,800. And again, we had 2 down 90% days. The last time we had that, that's advanced versus decliners. Let me see if I can get that for you. That's on FinViz, by the way. Yeah, I believe we had 90 advanced decliners. We ended the day on the advanced decline or market breadth. That was around 80 on declining at the close. We were as much as 90% decliners versus advancers. So, 9-to-1 ratio. The problem with that is the last time we had that was March 2020, and that indicated a bottom too. So again, you're going to get these snapback rallies. They're completely natural and normal, and it's really just all technical. That's the problem. You're not getting anything catastrophic either. But again, breaking the 200-day does not bode well for the future unless we recapture it and see if we can get up there. But as of right now we're back to around that 3,800 range target, 3830, 3,800. Let's see if we can get back to 3,900 and then sell it and see if we can run into CPI. I expect Monday to get a little bit of get a snapback rally, maybe get us to 3,900, and then I'll give us an opportunity to short into CPI, or if not, wait for CPI if we get a little more weakness, depending on how the market reacts on that. Let's go ahead and segue to next week's economic data. And this kind of replaces the weekly newsletters, just to get you guys have a heads up. So again, kind of go over everything. CPI on Tuesday at 8:30. We have core CPI as well. Wednesday, we have PPI, core retail sales, Empire State Manufacturing Index, and retail sales. So big week. Some good news. I know, right? We could all use some good news. No Fed speakers all the way to the FOMC, which is the week after. So no comments from Bostic or anybody else. There's a blackout period. They're not allowed to speak publicly in regards to NFP or the market or any of their commentary in regards to the market. So again, we'll have a little bit of reprieve from any kind of headlines like that. But again, CPI still looms large. The forecast is 0.4%. In terms of month over month, year over year will be at 6% is the forecast. If we can get below 5.9, that'd be a win. Very good case for the Doves to see if we only get a 25 basis point hike or a pause. We don't know about the Fed because they can't really comment now on what happened with the bank. Treasury Secretary Janet Yellen did, but again, didn't really calm anything. We'll see what happens. I mean, really, the Senate and the House testimony got the market down on Tuesday. We kind of chopped around, and yesterday with that bank headlines, we continued to fall. So Again, we'll take a look at some charts here in a second, but in terms of the news in front of us, we have unemployment claims on Thursday. That's every Thursday. Remember, we had over 211,000 in claims, so starting to crack a little bit. And University of Michigan consumer sentiment. That'll be on Friday at 10 a.m. Going up to next week, the week after, on the 22nd, we have the F1. Yet the unemployment rate ticked up to 3.6%. So I guess some labor cost reprieve, possibly, but that's where we are currently. Let's go ahead and say these questions. Feels like the dust needs to settle with SVB before Monday will rebound. I agree. And I believe any rebound that we get will be purely technical, nothing really fundamentally based. So, if you get a 400-point pop on Monday, we'll be back to the same place we were Friday in the morning. So again, it wouldn't be anything to get excited about. I think we just retrace this fall. And then maybe the bulls get a little excited. But again, as long as you're still below the 200-day, nothing really good is going to happen. You may play some snapback rallies, but we need to get above the 200-day and above that trend line before we can make any kind of long-term decisions in terms of being a bull or not, because we still need to break 4,200. Any other banks at risk is falling as well. First Republic was mentioned, another one seeing runs on their deposits. I didn't read anything yet, but I'll read the journal and scour the internet if I can this weekend. Anything that comes up, I will definitely tweet it, JD. Keep an eye on our Twitter. If anything that comes up, I'm always on top of that. But as of right now, JP Morgan, Morgan Stanley, Goldman Sachs, all these banks said this morning that bank that's their bank, and there's no issue with them. I mean, right, you're going to ask, the banks if the banks are going to be okay. Obviously, it's a confidence thing. We know the drill. Heaven forbid JP Morgan says they're insolvent. Another bank is insolvent. That bank will get a run. So again, it's a very, very delicate situation. Are the banks going to be honest about the actual ripple effect of this bank, which is Silicon Valley Bank? Will we ever know? We'll see. The only thing that we can see currently is the fact that it was worth about 56 handles to the downside on the S&P, including yesterday. We fell 140 handles from 4,000. And that's a bankrupt bank, or a bank that's going to be closed. I would have expected with some news like that to be a little worse. I remember in 2008 when WAMU, which was the largest bank that was closed, they actually had to close. But I think they got absorbed by Wachovia. But again, WAMU being the largest consumer deposit bank that failed, that had a little more effect on the market at that point. Obviously, environment 2008 and now. But again, really all I'm seeing here is that we're getting back to 3,800, back to a zone where we were really just in December. So again, we just have to kind of play it time by time. The price action is going to dictate to us all, because correlations are kind of broken at this very moment. Bond yields are down. That usually means stocks go up. Didn't happen. Dollar is down. Usually means stocks go up. Didn't happen. So again, we're kind of breaking that correlation. A little bit of fear taking over. Advance and decliners, 90%, 9-1. Usually get a snapback rally the next day when you get a back-to-back. So we'll see what we get from there. Let's take a look at that price action from 2020 and see if we can get a little bit of a hint on what happened then. Let's see if I can get here. Let's do the weekly. Let's see, 2020. 2020 in March, again, you can see the weekly. This was when we got the advanced decline. That week, we fell from 26.30 to around 22.70. And look at the next week, we had a nice bounce. So, wow, that was pretty close to the low. I think that was the day this week. Yep, the 10th through the 12th, if my memory serves me right. I read that on Twitter. Let me go and make sure. It was the advanced decliner number. Let me go ahead and take a look at it. I know I have my Twitter here. Okay, we're going to go to likes. Here we go. Last back-to-back 90% Dow days, volumes and points were 311 and 312. So you can see this was the week of 311 and 312. We did end up higher. I mean, here to around 2266 the next week. We went higher. So again, you may get some volatility up or down. That's a big range. Usually when you get that kind of panic, you get just those snapback rallies back and forth. So At this point, again, I've been saying this for weeks since the start of the year. We're not in an investable market yet. It's still a trader's market, just ping-ponging back and forth for a stock market that's really looking for some really stability in a sense, trying to find some direction, something to hang their hat on, and we don't know because we don't know what the Fed's going to do. Now, does this bank stuff, does this change anything for the Fed? Now there's rate cuts in play for the end of the year according to the Fed funds rate. So very, very murky waters here. But again, if you're just looking at price action, 38, I think 38.40 or 38.30 is our next level down. Again, playing a bounce. If not, it'll be 3,800. And that's really all you could do. Now, if we take out 3,800, oh yeah, then you're talking about the lows may be in play in terms of October. We're still not there yet, but we'll see what we get. Let's go over the trades of the week. Here we go. Tough one this week. You could see that, I'll go over it here. AMD was a great trade. AMD, we traded that on Monday, and we caught that rather quickly, same day. That was something that we sent on Instagram, and I sent the chart out on Twitter. So well done, and actually had a really strong week relative to the market. AMD closed today 82.67. So again, it did pull back, but we were in the money. 85, I believe, on Tuesday. Netflix, oh, that was a tough one. 330 calls. Let's go ahead and chart it together. Okay. What went wrong? Well, we'll go to AMD first. We'll recap this trade. AMD, look at this price action. On Monday, pop and then drop, and then pop and then drop, and then pop and then chop, pop and then drop, pop and then drop. I mean, that's pretty tough, I mean, to say the least. But we got out at least on AMD. Well done. But I think there was a member in our market chat that played it like 3 times. So again, I got it once. I'm happy with that. AMD was a good one. We got to the target at 85. That was our strike. We got as high as 87 and then faded. Never really looked to fade AMD. But again, if we do get a little bit of more weakness in the market, AMD will be something, and NVIDIA will be something that I'll be watching for. Let's go to Netflix. This one was the one, in my opinion, the toughest one of the week, in my opinion. Again, we had this nice break here. We broke down, and let me break this down here. Let's see. Again, I was looking to retest here, but again, got it on Monday, got that pop, trying to get back into the zone to this gap fill here at 332.36. We got slammed on Monday right as we get in, and then we just chopped around, looking to see if we can get that bounce. We didn't get it, and then just collapsed to 290. So a very, very tough trade. If we are looking at Netflix, what's next for it? You do have a 23.6 fib level here at 289.74. Kind of your zone of support would be 280. But again, you can see this rising channel did break down. So again, this would be invalidated in terms of Netflix. But I'll keep it up there. Tough one. That was the one I was really like, damn, swing and a miss. And that happens. I mean, that was a tough one. Google, looking at it now, kind of makes me sick, but whatever. I'm going to have to go over it anyways, just to even look at it. Okay, so Monday we pop. And let me make sure I get out Google here. Here's Google. Google, we got in on the 8th of March. We got in the 8th of March, so that was Wednesday, and the 97 strike. Let's go to Wednesday when we got in. And really what we were looking for is a break of 96. We get in on Wednesday. We got a break of 96. I got to 37% on this trade. 37. To show you even proof, we got to, I didn't send it out, that 37 hit, but check this out. And just looking back at it, I feel like I'm looking back at a catch that I dropped in the Super Bowl. But this is the reality of it. You can see 11:10 a.m., 3.8, we got 30%. And we didn't close. I should have closed it there. I thought we would get a little more momentum higher. Again, you could see that 96 level. We broke it and we got back into it again on Thursday, and it just faded with the market. If I would have took 30%, I wish I did, but I did not. But tough. But, you know, lessons learned and you move forward. Looking at SPY yesterday. Here's the SPY trade for yesterday. Now this one, I mean, we just got ran over on this one, and we got as high as 25% on it. So let's take a look at it. You can see on the recap, we got as high as 25% at 9:50 in the morning. Let's break that down. My God. The target was right, but unfortunately, we just missed it. Here's where we got into SPY, right on Wednesday. We're waiting for that gap up, which I expected, to 401.58. We were 50 cents away from in the money, which was my target to get out. And look what happens right at 10 a.m. We got slammed. Expecting at this zone that we would hold, we did not overnight. We did pop higher, but by that time we ran out of time. So we just had to eat our vegetables on that one. Tough one, but we were that close. 25% on SPY. Just kills me right there at 9:47 a.m. yesterday. Tough to see again, but it's like watching the highlights. You got to go over it. Very, very important to learn these lessons. So again, in the future, if you see 25%, 30%, and you feel comfortable taking it, that's totally natural and normal. I've done it before. There's times where we get 35, 37%. I say, guys, you know what? Who cares about 3 points? I didn't do it this time thinking that Google had the momentum. I didn't think of it this time thinking that SPY had a little more room. I thought we'd get to 402 and then I would close it and move on. But those are the two trades that were really tough to really take. JP Morgan, let's take a look at it. We were in calls here. In terms of JP Morgan, we saw relative strength. Look at that, up 2.5% relative to the banks today. And we took a look at the volume, and you could see on the 17th, the 135 and the 136 is 10,000 in vol. So very nice gain, 143, 155%. Basically, if you took it first thing in the morning. But let's take a look here. And this is something that I sent to everyone on the watch list and report. Watch list and charts. So every time we send out a trade, we break down the charts. And you can see here, nice pop from November. And you can see we tapped that support here right around December. We retested, we wicked it. But again, I was playing that support to get us as high to the 50-day at 135. We got there. We took it. Well done, everybody. There's a member on our team that caught it like 3 or 4 times, and which actually made up for Google and SPY. So there's always opportunities, guys. I mean, that's kind of the name of the game. Not happy about the week. Obviously, I have higher expectation of myself, but let's see what Monday brings. Maybe we can make up for that and see if we can get some good setups moving forward. Maybe we can play some reversals. We can fade some pops. We can buy some dips. Whatever we got to do to keep it moving. But you know, I'm not feeling too terrible for the week since we ended on a solid note. We ended on a green note with JPM. JPM has a lot of volume, got a runner running, so we'll see how far we get up there. Maybe we get to that 138 level, which was my target to begin with. That is the December 1st resistance. We broke it a couple times, kind of held it as well. You can see that's a support level from back in January to February. Very similar to SPY, right? Remember that? Look at this, JPM and SPY. Kind of similar, where you have that kind of support level here, right around that 405 area. So we'll see what JPM does. Maybe JPM gets more of a bid as banks are oversold. Time will tell. All right, guys, we'll leave it there. Have a great rest of your weekend. I will catch you guys on Monday for the morning note, and we will see you then. Cheers.